The ultimate due diligence. Is Berkshire Hathaway the right investment for your $10,000? Hello everyone, welcome to EPK Capital's deep dive video. I am your host, Rutvik. A common question among those entering the investment world is, would I invest my money in Berkshire Hathaway? For a new investor with $10,000, this is more than a simple query. It is the ultimate test of their investment philosophy. This report is designed not to provide a definitive answer, but to equip the prospective investor with the data, history, and strategic context necessary to answer that question for themselves. It is a comprehensive due diligence report on the multifaceted empire built by Warren Buffett and Charlie Munger, exploring its history, holdings, financial health, and potential future. The company and its promoters. The story of Berkshire Hathaway is one of an extraordinary transformation. The company began as a struggling textile manufacturing firm, which Warren Buffett purchased in 1965. His initial acquisition was based more on emotion than on a logical investment thesis, a misstep he later referred to as his most gruesome mistake, and a valuable lesson in what not to do. He quickly realized that the business's fundamentals were in decline and that its capital could be better allocated elsewhere. This realization led him to pivot away from textile manufacturing and use the company as a holding vehicle to acquire other, more profitable businesses. This decision laid the foundation for the sprawling, diversified conglomerate it is today, with a market capitalization of over $900 billion and Class A shares trading at over $650,000 per share. The genius behind Berkshire Hathaway's success is a legendary partnership. For decades, Warren Buffett and his longtime partner Charlie Munger worked as two halves of a single brain, combining their distinct yet complementary perspectives to make better investment decisions. Buffett credits Munger with teaching him that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This principle shifted Buffett's approach from simply buying statistically cheap, struggling businesses to acquiring high-quality companies with strong competitive advantages, what he famously refers to as economic moats. The company's operational strength is rooted in Buffett's unique, laissez-faire management style. Rather than micromanaging, he empowers his managers with a trust-centric management model. This approach hinges on selecting leaders who possess a trinity of qualities: integrity, intelligence, and energy. By delegating with accountability and selecting managers with a proven track record and strong ethical foundations, Buffett has created a decentralized organization that is operationally efficient and adaptable to changing market conditions. This structure is a core competitive advantage that allows Berkshire to manage a vast, diverse portfolio of businesses without the drag of a multi-layered, inefficient corporate hierarchy. The holdings. A look inside the portfolio. It is a common misconception to view Berkshire Hathaway as a traditional investment fund or mutual fund. Structurally, it is a diversified conglomerate that owns a wide array of businesses in their entirety, in addition to holding minority stakes in publicly traded companies. This distinction is critical because it explains the engine that powers Berkshire's growth, the insurance float. The float is a unique source of capital that sets Berkshire apart. It is the money that the company's insurance subsidiaries receive in premiums from policyholders before it is needed to pay out claims. This cash, which can total in the hundreds of billions of dollars, is available for Berkshire to invest as it sees fit. For example, in 2023, the float was reported to be $168.9 billion. This unrivaled mountain of capital acts as a form of non-interest-bearing loan that provides the company with a significant, low-cost source of funds for acquisitions and investments. A traditional investment fund must raise capital from investors and charge management fees, which are often a fraction of the capital managed. In contrast, Berkshire's float gives it far greater investment flexibility and allows it to opportunistically acquire temporarily wounded companies quickly. Based on Berkshire Hathaway's latest 13F filing for the quarter ending June 30th, 2025, the company's equity portfolio remains highly concentrated in a few major holdings. The top 5 holdings, which collectively account for a significant portion of the total portfolio value, are outlined in the table on left. Recent portfolio activity reveals a few key moves by Berkshire's investment managers. The company continued its strategy of trimming its stakes in some of its largest holdings, reducing its positions in Apple and Bank of America. Notably, it completely sold off its shares in T-Mobile and Citigroup. On the buying side, Berkshire initiated new positions in United Health Group, Allegiant plc, and Lamar Advertising, while also adding to its existing stakes in companies like Lennar, Poolcorp, Nucor, and Chevron. Berkshire Hathaway's investment history is a masterclass in both triumph and failure, offering critical lessons in capital allocation. The most profitable investment in the company's history is Apple Inc. While many investors, including Buffett himself for years, had avoided technology stocks, Buffett viewed Apple not as a tech company, but as a consumer brand with an unprecedented economic moat. Between 2016 and 2019, Berkshire invested approximately $40 billion, and by late 2023, that position had grown to over $150 billion. Other long-term successes include Coca-Cola and American Express. Berkshire began accumulating Coca-Cola shares in 1988, with Buffett stating his intention to hold the position for a long time, perhaps even forever. The company's conviction has paid off, as the stock has increased by over 3,500% since its acquisition. Similarly, the long-held stake in American Express dates back to the 1960s and has delivered more than a 100-fold return since the company went public in 1977. However, even the world's most successful investor has had his share of missteps. Buffett has referred to his 1993 acquisition of Dexter Shoe Company as his most gruesome mistake. He paid $433 million for the company with Berkshire Hathaway stock, but the shoe company failed soon after, due to competitive threats from cheap imports. 1. The ultimate cost of this error became clear years later. The Berkshire stock he gave up for the company would have been worth $12 billion by 2020. Another notable blunder was the company's investment in British grocery chain Tesco. Buffett was slow to sell out of the position when the company's fundamentals began to decline, leading to a loss of $444 million. The Financial Foundation, a decade of performance. Analyzing Berkshire's financials reveals a company with a strong and conservative balance sheet, albeit with a few nuances that can be confusing for a novice investor. The following table provides a snapshot of key metrics over the last decade. Berkshire's revenue has shown a general upward trend, although the numbers can be volatile year to year due to the nature of a holding company's business model. A key point to understand is the high volatility in the company's reported net profit. This is a direct result of accounting rules that require the company to record unrealized gains or losses from its stock portfolio. For example, a market downturn in 2022 led to a reported net loss of $26.05 billion, even as the company's underlying businesses remained profitable. This is a feature, not a bug, of Berkshire's financial statements, and a more reliable measure of the company's operational health is its operating income. On the balance sheet, Berkshire is notoriously conservative. The company's total debt of $125.93 billion as of March 2025 is dwarfed by its massive cash and cash equivalents position of $344.09 billion, giving it a net cash position of over $217 billion. Its debt-to-equity ratio of 0.19 is exceptionally low for a company of its size and speaks to its financial stability. The Value Investor's Lens, a Benjamin Graham valuation. Benjamin Graham, the father of value investing and Warren Buffett's mentor, provided a framework for estimating a stock's intrinsic value. He sought to guide investors in identifying undervalued stocks by looking at earnings performance and market conditions. The revised Benjamin Graham formula, which accounts for broader economic conditions, is expressed as V-EPS X 8.5 plus 2G x 4. 4 here, V is the intrinsic value, EPS is the earnings per share, G is the expected annual growth rate of earnings, and Y is the current yield of A-rated corporate bonds. It is important to acknowledge a critical nuance. Graham himself introduced this formula not as a definitive tool, but as a warning against the dangers of forecasting future growth. He used it to show how wildly unrealistic market expectations could be. This is particularly relevant for a company like Berkshire Hathaway, where earnings per share can be extremely volatile due to the accounting rules for its stock portfolio. To apply the formula, a few key pieces of data are needed. The latest trailing 12-month TTM EPS for Berkshire Hathaway is $29.17. The current yield on Moody's seasoned HA corporate bonds is 5.35% as of August 2025. Forecasting the expected growth rate, G, for Berkshire is challenging due to the volatility of its earnings, while analyst forecasts for EPS growth are negative at -9.83%, A more stable long-term forecast for revenue growth is 5.54%. When performing the calculation with the EPS growth rate, this result, a negative intrinsic value, is a clear demonstration of the formula's limitations when applied to a company with volatile earnings or a negative growth forecast. Alternatively, if a more stable revenue growth of 5.54% is used as a proxy for the earnings growth, the calculation becomes $467.97. With the Class B stock trading at approximately $500.98 as of early September 2025, the intrinsic value calculated using the revenue growth proxy suggests the stock is trading near or slightly above its fair value. A discounted cash flow, DCF model, which looks at future cash flows, estimates the fair value to be $705.74, indicating the stock is undervalued. This discrepancy highlights the reality that no single valuation metric provides a complete picture, and the formula's simplistic assumptions make it less effective for complex conglomerates. Berkshire Hathaway is far more than a stock. It is a diversified conglomerate with a unique, self-funding business model. Its history is defined by a legendary partnership, a disciplined approach to capital allocation, and an emphasis on long-term value. While it possesses significant strengths, including an unparalleled cash position and a robust portfolio of businesses, it also faces real challenges, such as succession planning and the difficulty of generating outsized returns at its current scale. Returning to the initial question, is Berkshire Hathaway the right investment for your $10,000? The answer rests on your personal investment philosophy. To make an informed decision, a potential investor should consider a few key questions. Does the company's buy and hold forever philosophy align with your long-term financial goals? Are you comfortable with the inherent risk of a concentrated equity portfolio, particularly its significant reliance on a few holdings like Apple? Do you trust that the company's culture and its named successor, Greg Abel, will be able to sustain its success in a post-Buffett world? This analysis is provided for educational and informational purposes only and does not constitute financial advice. Investors should conduct their own research or consult with a qualified financial professional before making any investment decisions. And that's all we had for this video. We hope this video was informative for you. If you think it was, then please do like and share this video. Also, do not forget subscribe to our channel for such wonderful daily content. Also, if you are interested to watch the videos in Hindi, then you can also subscribe to EPK Capital's Hindi channel. You can also follow us on Instagram and Twitter. The details are in the description. Thank you for watching.